The new retirement savings time bomb from Ed Slott, part 2. That's right, I'm back. I promised I would give you more, and I know we're not going to get it done in one segment, but we're going to talk about things that retirement savers can diffuse this time tax bomb, what Ed Slott says you should do, and my thoughts on the subject as well. So Ed and I would both say that this is true. Ed's broken it down to 5 easy steps. I'm a checklist junkie, in case you haven't recognized that from listening to the show over the period of time. One of my at least top 7 favorite books is the Checklist Manifesto. Strongly encourage you to read it. If you do not use checklist, you probably will by the time you're done reading the book. So what are the 5 easy things that you can do? And I'll argue with that over easy, but it sure sounds good, doesn't it? Easy things that you can do to diffuse the tax time bomb. The first one is by timing it smartly. Now let's go back for a second. What in the world is the tax bomb? The tax bomb is that inability for you to control the future. The decision that the IRS is going to make, Congress is going to make regarding what's going to be taxed in the future, how it's going to be treated. I like the analogy of the kid with the ice cream cone who agrees not to have ice cream at the beginning of the day if he can get 2 scoops at the end of the day. The problem is nobody explained to him that the size of the scoops would change. They could be bigger. They could be smaller. Nobody talked to him about the flavor, meaning what it's going to go with at the time. Your tax return, by the way, is an orchestra. It's a symphony all working together. And when you have income, regardless of what the source is, this is where some people get into Roth IRA complications. People look at the tax return as individual lines. What did I get from Social Security? What did I get from dividends? What did I get from interest? They all go on the form. But the reality is they all work together to figure out what tax rate you're going to be in. And just like the little kid with the ice cream cones, the scoops can be much, much smaller if the tax rate changes. We call it a retirement savings time bomb. When you get your 401k statement and it says you have $1 million inside of the 401k, but it's all tax deferred, right now, it's going to cost you $250,000 to get it out. But in the future, it may be $400,000. The top tax rate, by the way, that most of you've lived with was when Kennedy took office. It was 90%. When Reagan took office, it was 70%. And back in 1986 is when they got it down to 15, 28, and 31. So that's the time savings tax bomb, if you will. It's coming in the future. So what are the 5 easy steps? The first one is timing it smartly. By choosing the right time to start taking your money out of your retirement accounts and the right amount to take, you can escape racking up the huge tax bills plus penalties that stem from withdrawing too little, too early, or too late. So most people I have found that do this on their own, when you're acting as your own fiduciary, do not pay attention to their tax return. I have a lady in Lafayette, Indiana that I love dearly. I truly do. I mean, these people are like my grandparents in many cases, and it's just a wonderful opportunity to be able to serve people. But when you've taken care of somebody for 25 years, there's an emotional attachment. So the first 5 years that I worked with her, she did her own taxes. And she would bring in the taxes at the end of the year, not to do tax planning, but just to show me what the return was. And each year I would look at her and try to explain what I'm about to tell you. She had $2 million inside of a 403B account. Her and her husband were both professors at the university. He'd passed away before I got to meet him. $2 million inside of a 403B. The house was paid for. The cars were paid for. She had enough other cash. And so she was taking very, very little out of in any place, in all fairness, but a little bit of money out of her checking account that had already been taxed. No money out of her 403B because she hadn't been forced to yet, because she hadn't hit required minimum distribution. And she didn't take Social Security as she shouldn't have based on the other resources that she had. And so for 5 years, I would look at her and go, listen, here's how much money we are losing. Here's how much money we're losing. Well, she finally got to the point where she was 2 years away from required minimum distribution. She was 68. And I said, here's the amount of money that we have given up to the IRS over the last 5 years. And she got white in the face and she goes, what do you mean we gave up? See, the IRS gives you a set of rules. And this is not about cheating in taxes. This is about making the most of the opportunity, if you will. You've saved and accumulated this money, and you've looked at your tax rate. You don't need the income, and so people are reticent to take money out of the account if they're not going to actually use it or spend it. I get that. I understand that. The problem is, just because you take it out doesn't mean you need to spend it. But somebody, either you or your heirs, are going to pay taxes on that money. And maybe if you leave it to a charity, that's not the case, but we don't know what the future tax code holds, so maybe you still have to pay it. Who knows? It's still part of your gross estate, even if you give it away at death. But the point being is she could have taken out money at a 0% federal tax rate, a 0%. Right? And then there was some money that she could have taken out at 10%, the lowest tax bracket we've ever had. Right? But she didn't, because she wasn't thinking about tax planning. She was thinking about how cool it was to not have to pay any taxes along the way, how cool it was to get that 403B statement and watch your accounts continue to soar in value. But the whole problem is, as it continued to grow, that time bomb that Ed Slott talks about was continuing to exacerbate. It was continuing to become a worse condition. And at 68, when I told her at age 70, at that point in time, when I told her at age 70 she was going to have to begin to take required minimum distributions that were over six figures, it was, it was about $80,000, I think, $85,000 if I remember correctly, that she was going to have to take, and Social Security was going to have to start that year because you can't wait past 70 in order to get it. All of a sudden, she was going to be not in that zero tax bracket that she was in, but she was going to be up 2 or 3 steps on the bracket for no reason at all other than not actively engaging in the tax planning. So there's a decision to make: do I spend or do I save? But there's also another decision that the IRS lets you make about when you want to be taxed. Once you've reached those penalty-free ages of 59 and a half if you're in an IRA or a 403B or 401k, sometimes 55 if you're in a 401k, you can make the choice about when you want to recognize income, when you want to spend the money. I would strongly encourage you to consider that as part of your tax planning strategy. Second is secure it. Right? Now, Ed says, don't be fooled by the name Congress gave to the recent raid of your retirement savings. They call the law the Secure Act, but it does the exact opposite when it comes to retirement funds you leave to your children and grandchildren. With the elimination of the stretch IRA, you need new planning alternatives to avoid the tax hit your beneficiaries may take. That's right, the tax rules have changed in terms of how people have to take that money out when they receive it. Now, here's a hilarious thing. When it comes to the tax code, there's 2 names that I always pay attention to. Natalie Choate is the one that I listen to and go to when I'm in the CE professional setting, if you will. Ed Slott's the one that talks to the consumers, that helps me to put it into English and brings in English-speaking people, and I don't mean of our nationality. I mean, puts it in terms that my poor little head can understand and yours can understand. And we sit here and look at this and try to figure out what it means for the future. Secure Act sounds really safe and good on the outside, but it is certainly anything but that, and changes some of the rules in terms of distribution of your 401k and your IRA, not to your spouse, but certainly to your kids and to siblings and other people of that nature. The interesting part is some of this stuff in Secure Act 2.0 we really don't have the answer for. And in one of the media outlets, and Ed Slott's in many of them, and again, you can find him at IRAhelp.com, him and as well as the rest of my group. We're all on his website one way or the other to be able to find advisors that are trained in his type of thought process. But when you go through the article, and one of the articles, I can't remember if it was Wall Street Journal or Forbes, but I think it was one of the two, that essentially said, it got down to asking Ed an answer, and Ed said, we just don't know. And the quotation that came from the author is, if Ed Slott doesn't know, nobody knows. And that's really where we are with the tax code today. There's a lot of stuff that's going on in Secure Act 2.0 that we don't know, which is why, in my opinion, you have to build flexibility into your financial planning to be able to deal with the IRS, not just today, but 10 years from today. When you're pulling the money out, when you need it for distribution for your life after work, when you need it to be able to give to your heirs or your charitable entities, you need a strategy that's 10 years out that provides some flexibility for changes that will occur in the U.S. tax code. There's no way around it. I won't tell you that taxes will double or triple or go down by half. All I know is they will change. That I will bet my net worth on. they will change from where they are today. And so you've got to be ready to not be flat-footed, but if you will, to be on the balls of your feet like a basketball player to figure out the best way to use your money. So you want to understand that impact of the stretch. I have argued long time that it makes most sense for American families to have conversations with their kids about their resources. I totally disagree with Wells Fargo commercial from the Wells Fargo golf event. It just blew my mind. They ran the commercial 20 times. This attractive lady, financial advisor, said, "We believe you need to talk to your kids about your life savings so that they have a safety net." I don't think you want your kids to think that they have a safety net in terms of your income or your assets. I thought it was the craziest commercial I've ever seen in my entire life. I do believe you need to communicate with your kids, though, because of the tax nature of what it is you've deferred and saved. Not so they can sit back and count money waiting for the days for me to pass. Not so they can sit back and say, I don't have to work hard because mom and dad already did the work for me. I don't think that's the case at all. But understanding the tax implications are very, very, very important. Now, we got 2 of the 5 done. That means we have 3 steps left that we're going to talk about in another show. Make sure if you're listening to this, remember you can always go to a podcast channel. Anywhere you listen to podcasts, put in Your Retirement Playbook. You'll be able to find more shows like this. Consider this program was years and years and years. Eventually, the names will be rechanged to Your Retirement Playbook. But you can find stuff there. Consider this program or Your Retirement Playbook. And don't forget YouTube. If you like watching this on video, every now and then we have a blackboard. I used to call it a whiteboard, so if I slip, I slip. But it's a blackboard that I'm able to draw on behind. Obviously, if you're listening on the radio or even listening on the podcast, you won't be able to see it, but you will be able to if you're watching it on YouTube. It's a freebie. If you need any questions about how to get a hold of us, just call the office, 800-928-4001, or go to yourlifeafterwork.com. Our technology guy, Ron, will be more than happy to get you set up to be able to watch the show. Have a great week.